morning, everybody, and thank you all for joining us this morning. My name is Daryl Hannington, and I'll be hosting this morning's webinar. The specific discussion today focuses around recent changes in the Tax Act with a specific reference to looping structures. While we admit that there are various implications for South African investors with money abroad, we think that this is a very positive step in the right direction from a regulatory point of view, with possibly more changes to come. Joining us this morning to help us unpack this complex situation, but most importantly to try and identify where the opportunities lie, is Andrew Wellsted. Andrew is a lawyer and tax advisory specialist. He is focused and specialized in, amongst other things, cross-border transactions. He has over 15 years of experience in the industry, having worked at a major multinational law firm until 2018, where he broke away and co-founded his current firm, CMS. Please feel free to use the Q&A button at the bottom of your screen, and we'll try and field as many questions as possible at the end of Andrew's presentation. If we can't get to your question for whatever reason this morning, please contact us here at Anchor Capital or your financial advisor so we can take the conversation further. Andrew, thank you again for your time, and over to you.
Good morning, everybody. Thank you, Daryl. Thanks very much for having me. As mentioned, today we're going to touch on a couple of topics, some not obviously linked together, but I think the key link, and I'm going to start with the big takeaway of today, which I'm going to repeat a couple of times during the course of the discussion, is that the regulatory framework surrounding offshore structures, and to a large extent it's been driven by exchange control changes, is very fluid at the moment. It is moving in a direction that I think is positive for most South African residents, or what we used to call exchange control residents. So the fluidity is positive, it's going the right way, it's providing us with the ability to restructure our affairs in a more optimized way. And the message is really this: everybody, I think, obviously you need to have a certain level of, or minimum level of wealth, but everybody needs to relook at their estate planning structure to see what these changes do and whether or not their particular estate planning structure can be enhanced. And in my experience, a large percentage of people can enhance their estate planning structure by looking at these new rules and re-looking at their estate structure. So if there's one takeaway from today, it's please go and sit down. I know it's a hateful thing to do, but look at your estate plan. Take what I've said regarding, in particular, loops, but other changes as well, and have a rethink about whether or not your current estate plan is the correct one at this point in time. Obviously, it is a complex field if this isn't your day job. So, you know, as Daryl said, contact Daryl and team or myself or whoever you use to make sure when you're analyzing the appropriateness of your structure, whether or not you're making the best out of these changes. Okay. So that's a message that I'm going to keep pushing over the course of the morning. The big takeaway is it's time to relook at your structures. So the first thing I'm going to touch on, and I'm going to build everything up from the ground up because I don't know everybody's levels of expertise that are in the audience. So I'm going to build everything up from the ground up. And the first thing I'm going to touch on is so-called financial immigration. Now, financial immigration is a term that referred in my particular world to exchange control immigration. Now, let's just unpack that for a minute. Most of us who grew up and have lived in South Africa for long periods, or have lived in South Africa for long periods, are both tax resident in South Africa and exchange control resident. And in most cases, both of those things overlap. In other words, you will be resident for both purposes. But exchange control is a different regulatory regime from tax. And the tests are different. So it wasn't always true that if you were exchange control resident, you were tax resident and vice versa. As I say, in most cases it was, but it wasn't always true. Now, financial immigration referred to immigrating for exchange control purposes. It was normally coupled with an immigration for tax purposes, i.e. ceasing to be tax resident. And just to dig into the detail a little bit, when you cease to be tax resident, you have to do a tax return that notifies the SARS that you are ceasing to be tax resident, and you are deemed to dispose of all of your assets. So you pay CGT on all of your capital assets except immovable property. And that's the process for tax immigration. For exchange control immigration, one needed to notify your authorized dealer at your commercial bank that you were immigrating. You needed to do a form MP336B, which was the immigration form, and then you would cease to be resident. Now, a lot of the stuff that I'm going to talk to you about today is so new that you will forgive me, I don't know all of the answers, and I don't know if everybody knows all of the answers. For example, on Monday, we got a new circular out of exchange control dealing with immigrants, which I'm going to talk to you about for 2 minutes quickly now. Now, a lot of people are very puzzled when I say to them that exchange control is being relaxed. Let's just unpack it for a minute. Exchange control has been with us for many, many years. It derives from the Currency and Exchanges Act, which, if I'm not mistaken, is 1933. So for several generations of South Africans now, we've lived under exchange control. And it seems counterintuitive to many that they would be removing exchange controls at this time when the economy is in a dire position. But that comes from a philosophy that has possibly been inculcated into us, that exchange controls protect our economy. And that may be fallacious. It may be that exchange controls are a disincentive to investment, that foreign investors don't like to invest in jurisdictions with exchange controls because they're not sure that they can get their money out. And it may also be that things like loop structures, which we're going to speak about just now, prevented people from reinvesting their money through a specific rule. So in fact, it was a specific disinvestment to reinvestment. And I think if you look at the president's emphasis on foreign investment, in fact, the relaxation of exchange controls at this point in time ties in with that. Because some of the changes that we see, yes, it will be easier to get your money abroad if you want to do that, but it will also lessen the urgency to do so. Currently, or up until the beginning of this week, as you'll see just now, a lot of my clients, if they had 10 million lying around, there was no question that they would take the 10 million rand out. Why? Because each person, as you know, could take a foreign investment allowance of 10 million rand per annum. And, you know, when you were uncertain whether you would be able to do that going forward, i.e. what was happening with exchange controls, you took that 10 million. There was no optionality to it. I've got 10 million. I need to rebalance my asset base offshore, so I'm taking my 10 million. If you can do it today or tomorrow or next week, number one, it lessens the urgency to move capital out. And the other thing is that a lot of South Africans have taken their money abroad are struggling to get the returns that they can get here. We live here, we know the environment, we know the opportunities. So you may see that some of the foreign funds that are owned offshore will be reinvested back into South Africa, simply given the fact that they know that people will have the certainty they can take it out. It is speculation. I don't know exactly why they've removed exchange controls. As I say, the official reasoning given was inward investment. And to a large extent, as somebody who practices in this area, I do believe that exchange controls have been something that created resistance to inward investment. So personally, I think it's a very good thing. The most recent change, as I said to you, relates, funny enough, to financial immigration or immigration for exchange control purposes. And all of the changes that we're going to talk about today, including this one, really emanate from the budget in 2020. Now, the budget in 2020 was a watershed budget, in my view. And it went largely unnoticed because it wasn't about taxes. It was about exchange control. There was an Annexure E in the 2020 budget, and you can go and look at it on the Treasury website if you want to do that, where the minister outlined his vision for the effective dismantling of exchange control. And he did it in very clear terms as to what was going to happen. Of course, a couple of weeks later, the world was swept up in the pandemic craze. And all of this really important news about what was going to happen with exchange control got swept aside. In addition, the coronavirus added some uncertainty as to whether or not the policies of the government that had existed pre-COVID, including the dismantling of the exchange control regime, would be continued with. But nonetheless, if you go and read Annex E of that budget, it's not long and it makes for very interesting reading. As I say, the minister outlined very clearly what we're going to talk about today. So, moving back to financial immigration. The one thing about financial immigration is that it became productized in the market. If you Google it, you'll see a range of cottage industry firms offering people financial immigration. In other words, they would help people immigrate for exchange control and tax purposes, although it wasn't couched in those terms. The problem that I and many sort of technical tax advisors had with it is immigrating is not always a tax or a exchange control solution. In other words, the general approach that predominates in the market is decide how you want to live and where you want to live and what you would like your lifestyle to be, and then structure your affairs around it. A lot of people believed that they should immigrate for tax and exchange control purposes, which wasn't the case. And that's why it became a little bit controversial. There were people offering to immigrate you, and it was felt that often they didn't interrogate whether or not immigration was the correct solution for the person in question, or whether or not it was appropriate for the person in question. So what tended to happen was if you went to one of these people, you ended up immigrating whether it was the right thing or not. And so-called semigrating, where you half immigrate but actually stay in South Africa, can have very adverse effects. But nonetheless, the latest update is that as of Monday, Exchange Control released Circular 6 of 21. And these circulars come out on a monthly basis and on an annual basis. And they advise on, amongst other things, the changes to the Exchange Control Manual. Now, we are expecting, if you go and read Annex E, we are expecting an entirely new capital flow system. In other words, I believe that the Exchange Control Manual in the next couple of months will be entirely overhauled. In other words, it will be amended and we'll have a new set of rules in place. It doesn't mean, and what I'm not saying is that when you log on to your internet banking, that you're going to see Royal Bank of Scotland and you're simply going to be able to transfer your funds anywhere you like. There will still be a process of engagement with the commercial banks through which all currencies that flow in and out of the country move, and all of the currency flows will continue to be reported. But I do believe, as we'll discuss today, that we are moving to a position where the requirement to gain approval will become will in fact fall away. In other words, you will be able to decide what you do with your funds and where your funds sit freely, as long as you can meet certain regulatory tests such as anti-money laundering, etc. So just to jump then, to keep us within the theme of financial immigration, so you can see I'm getting old, I have to take my glasses off to read it to you, but I'm not going to read you the whole circular. But circular number 6, as I said, came out on Monday, is entitled Phasing Out the Concept of Immigration as Recognized by the South African Reserve Bank. Now, again, this came from the budget in 2020, where they noted that immigrants and residents would be treated the same. I wasn't quite sure what that meant, but from the circular, we can see that the first steps that they've taken is that there are certain rules that apply to immigrants. You may have heard of the concept of blocked funds, where they can't move their funds abroad, they have to get certain approvals, etc. Essentially, what's happening is that the split between exchange control immigration and tax immigration is falling away. From now on, exchange control will look to tax immigration as the key to whether or not anyone has immigrated for, well, the concept of immigration for exchange control purposes will now look at the tax rules. So, for example, if you want to be treated as what would have been formerly known as an immigrant, and the reason that I'm using slightly inelegant language around this is that the concept of an immigrant has been deleted from the lexicon of the Exchange Control Manual. But essentially, immigrants will not be treated differently from residents. They will have the same access to allowances, and all they will have to do is get a tax clearance certificate that, in addition to what you need to get now if you're moving your 10 million rand abroad, also confirms that you are ceased to be resident for tax purposes. Linked to this, for example, and something that you may well have heard, is that now, and this starts from 1 March, if you are seeking to externalize your pension, you'll only be able to do that if you have ceased to be tax resident for 3 years in a row. Previously, you would so-called financially immigrate and cease to be a resident for exchange control purposes, and then you would have been able to move your pension funds. But as I say, it's all linking back to the Tax Act. So let me give you the highlights, if I may, of Circular number 6 of 2021, which came out on Monday. They note that immigrants are to be treated as residents. In respect of applications above the 10 million mark, you must verify tax status, and there needs to be an approval by the Reserve Bank. So what I said to you is we're moving away from approvals. Currently, we're going there gingerly, but my sense from it is that if you emigrate for tax purposes, you'll get your tax clearance certificate, you'll take it to the authorized dealer, and you should be able to take out more than the annual 10 million allowance, which will now apply to immigrants, but it will be a more stringent verification process. They say that the current process of controlling or blocking an immigrant's remaining assets in a special block funds account will fall away. So that's very interesting. If you do have relatives, or if any of you have immigrated and you're dialing in and you've got blocked funds, which was a feature for people who'd immigrated, that will now fall away, and you should be able to move your funds freely. The process of MP 336B, which was the form that I mentioned to you previously, will now fall away from 1 March. They say all new immigration-related applications from 1 March will be processed by SARS based on a new dispensation of confirming that the taxpayer ceased to be resident for tax purposes. So that's very, very interesting, and it's a very significant step. Again, exactly how the implementation will play out, what forms you'll need to fill in, what the engagements with your authorized dealers will be, I don't know as we sit here today. But what I can tell you is that the momentum to dismantling the exchange control regime, which, as I say, was announced in the 2020 budget, continues. There were other notices that came out on Monday dealing with things like dual listings. So the commitment to dismantling the exchange control regime seems to be there. Steps are being taken, and it's very interesting that we had said that one of the aspects we're going to touch on is financial immigration, because this is the latest regulatory step in the concept of financial immigration. And what you can see from what I've told you, just to sum up, is that the concept of immigration from exchange control purposes, which had its own test and had the concept of an immigrant, is now being done away with. And all immigration will be linked to tax immigration. And as you know, tax immigration looks at whether or not you are ordinarily resident for tax purposes, or you are resident under the physical presence test. So very interesting, very novel, and quite convenient that we put that in our discussion points today, because that is the latest in financial immigration, and it's hot off the press. The other development, which I think we're going to spend a fair bit of time on today and is really significant, relates to so-called loop structures. Now, loop structures have been with us for several years, and I'm just going to share the screen if you don't mind. I hope you can all see that. If you can't, I'm sure somebody from Anchor will let me know. Now, that diagram there shows a South African resident. We'll call him Daryl. And as you can see, Daryl owns nothing in South Africa. Daryl is a beneficiary of a foreign trust, which has a holding company, and the exact structure that I've used in this diagram is just indicative. There's a range of estate planning structures one could use offshore. I just used a trust and a holding company because it's relatively commonly encountered. And you can see that that offshore structure has two key asset bases. It owns assets offshore, which is not uncommon in our experience now. And it also owns South African assets. Now that's very interesting, because that depiction is what would previously have been called a loop structure. So just to give you the slightly technical version of what a loop structure meant, a loop structure was prohibited, and it referred to a structure where a South African resident, Daryl, owned an interest in South African assets, but via an offshore structure. So just to unpack that, you can see Daryl and the SA company, which is the assets in this case, are both in South Africa, but he doesn't own it directly. He's a beneficiary of a trust, which then indirectly owns the South African asset. So that's up until January 2021, and so it's 2 months ago, but it's fresher than that. It was prohibited. There was some relaxations during 2020, but I'm not going to dwell on those for now. So this is a really, really important step. Daryl now can own South African assets via an offshore structure without contravening exchange controls. Okay. Really an important step, and as I say, very, very novel. So what does that do for us? And this is where I say we need to start rethinking our our estate planning structures. Okay, I'm not going to put it on full screen. Apologies. You're going to just see my surround if you don't mind. But as long as you can see the diagram, that's what's important. So because largely of the prohibition against loop structures, a lot of South Africans' estate planning structures developed in the following fashion. You can see that in this diagram, Daryl is a beneficiary of a South African trust, which has a South African holdco. Below that South African holdco, there are South African assets. He also has taken money abroad and has set up a foreign estate planning structure, much like the structure that I showed you previously. And that structure exclusively holds offshore assets. Now, that's a very, very common scenario that you find amongst this South African estate plans. And the reason that it exists and that it was done that way is, as I say, because of loop structures. It was prohibited for Daryl to own his South African assets from abroad. And that's why so much estate planning has been done on this basis. I'm suggesting that as exchange controls relax, okay, this will become more of a common estate planning structure. And what you can see when you look at this diagram is that Daryl's his local estate planning structure has been whittled away to nothing. And we're going to talk a little bit about how you segue from the one structure to the other just now. But the reason for that is that South Africans generally, in my experience, would prefer to have their asset base offshore. And that's because primarily there's a range of reasons for it, but I think the most commonly given reason is that the rand is really very volatile. And it is vulnerable to big movements. So, you know, many of you will remember Nene-gate when the Minister of Finance, Nene, was fired. And if I remember correctly, the rand dropped somewhere between 20 and 25% very suddenly. And it's those sorts of currency exposures that can dramatically reduce your wealth in real terms. If all of your eggs are in one basket, being South Africa. So what you can see in the present structure, Daryl hasn't completely exited South Africa. Of course, he's still got valuable assets in South Africa, but what he has done is his primary estate planning structure is located offshore. I often get asked, where offshore must it be? And the fact of the matter is there are many, many jurisdictions that are friendly financial centers that one can use as basis for your estate plan. And it's something that you shouldn't get bogged down on. You should just know which are the better jurisdictions to use, and then you can use any one of them, and the final decision base is actually based on your facts and figures. There's no one size fits all. So where it is not that relevant, but there's no point moving from a high tax, high regulatory jurisdiction like South Africa to another high tax, high regulatory jurisdiction. So you need to make sure that you are either in a financial center where your trust is not going to get taxed too heavily and there's not a proliferation of taxes, or you're somewhere that has what we call either non-dom rules or a holding company rules. And there are a couple of jurisdictions that you would be surprised at where you can base a foreign trust, and as long as you're not located in that jurisdiction, it can be friendly. Funny enough, the USA is one of them, where as a non-resident you can have a USA trust holding non-USA assets, and it can be done in quite a friendly way. So you can see, and this comes back to the point that I promised I was going to bore you with throughout the discussion, you should be looking at your estate planning structure, and you should be looking at whether or not it is appropriate for you to start migrating your estate planning structure as I've depicted here. As I say, the removal of exchange control is going to make it easier and more robust to do. Okay. In the present structure, we've got a foreign trust and a foreign holdco with South African assets. Now, part of the question is, how do I move my South African assets in a way that doesn't cost me too much money? And what are the benefits and implications of doing so? So we know now that it's legal to move for Daryl to own his South African assets from offshore. And there seems very little sense in duplicating having a South African structure anymore and an offshore structure. So as we increasingly become part of the global economy, and that sounds strange given the date today, but removal of exchange controls is a significant step in us becoming more international players than we have been. So Daryl's going to start moving his estate plan into a foreign structure as his primary estate planning base. What are some of the things that arise? Well, number one, there is CGT, and we're going to talk about that last. If he or his South African trust, if we go back to this diagram here, disposes of these assets into the foreign structure, we'll talk about CGT. I'm going to talk about that last, though, if you don't mind. What the immediate issues that one should look at is, so in this case, Daryl's got a South African company, and he has sold it to the foreign structure. You can see that I've put two acronyms there, DWT and ED. Now, these stand for dividend withholding tax and estate duty, and they're just two of the local taxes that I want to look at that are different once Daryl has migrated his estate planning structure, as I'm suggesting he does. So back to this diagram. In this diagram, where the holding company declares a dividend, and you can see that little line going up there, to a South African resident that's not another company, i.e. a trust or Daryl, there's dividend withholding tax at the rate of 20%. Interestingly enough, once Daryl has moved ownership of this South African company into a foreign structure, the dividends withholding tax can be dropped to 5%, or in some circumstances, even 0%. Now, is that an aggressive scheme that I'm proposing that achieves that? The answer is no. South Africa is party to a number of double tax agreements throughout the world. And one of the purposes of double tax agreements, the primary purpose is to avoid two jurisdictions taxing the same income stream. But a secondary purpose is to limit local taxes. And that's exactly what a lot of these double tax agreements do. So many of them say, South Africa, if we have a South African resident, i.e. the South African company, paying a dividend to a non-resident, which is a resident of our country, i.e. the counterparty to the double tax agreement, then South Africa, you may not levy dividends tax at the full rate. And as I say, many of our double tax agreements lower the dividends withholding tax to 5%, and some of them even lower to 0%. So let's just take the most extreme example, because it's always the most illustrative of the principle. In this case, Daryl's holdco, his foreign holdco, is in a jurisdiction where the double tax agreement lowers the dividend withholding tax to 0%. In other words, the South African company will no longer have to withhold any dividends withholding tax at all. If you contrast that to the previous scenario where the dividends were being declared locally, that's a substantial saving. And that is just a natural consequence of Daryl selling his South African assets into the foreign estate planning structure. It is not any fancy or aggressive estate planning. It's just simply, tax structuring. It's just simply a consequence of the estate plan. The other thing that should be evident, and this refers to the estate duty point that I made. Again, if you look at this diagram, where the funds were exported is in terms of that top arrow, you can see the little dollar sign there, and that was by Daryl himself. So what needed to happen was that the structure, his local structure, would have to distribute funds to Daryl. Sometimes it lent it to him, but let's work on a distribution in this case. And then Daryl would make the application with exchange control to take out his 11 million or a greater amount. Okay. And the reason that we did that was for various technical reasons, it was preferable for the individual to export funds than for the trust or the company. Now, inadvertently, what we were doing there was creating an estate duty trap, because we would vest the funds back in Daryl. Daryl would externalize the funds and fund the foreign structure. And although on a balance of all of the commercial factors, that was the preferable thing to do, we'd put 11 million rand back in Daryl's estate. In the structure that I'm suggesting, you can see that funds go to the offshore structure from the local company as a dividend, okay? And they go directly. I'll talk a little bit about the process of payment now, but the funds go directly, they never touch Daryl. And in that way, although not many people worry about estate duty, it is something that you worry about in your twilight years, and it's a substantial cost. The estate duty, as you know, is anywhere between 20 and 25%, depending on the value of the estate. That is a huge chunk of your estate to lose. So there was an inadvertent estate duty trap in the way that we used to move funds abroad, which will now also, just as a natural consequence, again, I reiterate, not as an aggressive tax plan, as a natural consequence of moving ownership in terms of the loop rules, you will necessarily be saving that future estate duty as well, which is a significant benefit. Then just touching on how the funds move. Under the current loop rules, which I believe is circular number 1 of 21, if anyone wants to go and look at it, is on the Reserve Bank website, and I'm more than happy to circulate all of the documents that I've referred to. I'll chat to the anchor team about that, and I'm happy to do that for anyone who's interested. They are public documents. What do you have to report when you loop? So the way that the circular is framed is that loops are now legal. They have deleted the prohibitions against loops in the exchange control manual. You don't have to ask permission to create the loop. That's a very important point. You don't have to ask anyone if you can do it. You can enter into the loop, i.e. Daryl can sell, or Daryl's trust can sell that SA company into the foreign structure. And once the transaction is complete, you have to report the sale to the authorized dealer. You can assume, of course, that the authorized dealer will then report that to the South African Reserve Bank. And there will be an annual report on the status of the loop, okay? But loops are not prohibited. That is a significant legal fact. If you're a lawyer, there's nothing illegal about them. You just got to report them. One of the factors that they will be looking at is values. So if you are trading, I think you can take it as read that you do need to substantiate the values that you do any transactions at when you are transferring your assets into the foreign estate planning structure. And by the way, that's true for tax purposes as well. So it's no additional burden to have to do it, but for reporting purposes, you'll be well advised to make sure that you can corroborate any values that you transact at. And normally that's done with an independent valuation from somebody like your auditors. Okay, so before we move on, I'm just going to stop there and take stock of what we've covered so far. In 2020, in February, if you can imagine, it was in a time pre-COVID, it seems impossible now, but the Minister of Finance announced the relaxation of exchange controls in quite clear terms. We then waited for a long time while the policies were changed, but in 2021, 2 very important notices have come out. They're not the only notices, but 2 very important ones. In early January 2021, we were notified that the prohibition against loop structures has been removed. In other words, it is now legal to loop. And the second one, which doesn't necessarily tie into estate planning, but is important because it is relevant to a lot of South Africans, is that the concept of financial emigration has fallen away to some extent. And the South African Reserve Bank, any applications regarding movement of funds for what we used to call immigrants are now aligned with the tax tests, and they no longer have separate tests or separate immigration processes. And that is significant. In addition, my reading of it is that it will be easier for people who are immigrating to access their funds, including funds that are blocked currently. This momentum to relax exchange controls creates opportunities for South Africans to relook at their estate planning structures. And rightly or wrongly, many South Africans are seeking to rebalance their asset base and to have less than they currently do in South Africa and more offshore. Of course, your percentage of assets onshore and offshore is a personal decision. There's no right or wrong in that. But there is a general trend that whatever your preferred asset allocation is, people want more offshore. This necessitates relooking at your estate planning structures. Unfortunately, it's something people don't like to do because it's very boring and you get people like me throwing all sorts of facts and figures at you. But I think that it will be a beneficial process if you do so. The most immediate change that is with us is that the prohibition against loops has been removed. And as part of this emigration of assets into offshore structures, one can now also transfer South African assets into foreign structures because it is legal to own South African assets from abroad. Okay. So that's just a little sum up of where we are. I want to now move to my last slide, if I may. And what this slide deals with, let me just see if, there we go, now we're transitioning quite neatly. What this slide deals with is some of the things that you need to think about when you're actually selling your assets into that foreign structure or transferring them. These are the levers. And for any of you who have ever done very complicated estate planning, it's quite a frustrating process because you answer one or you resolve one problem in estate plan, and by doing so, you create another one. In other words, there is no estate plan that is perfect and does everything that you want. They are always a compromise and a weighing up of competing commercial interests to come to the right estate plan. And that is also true of rebalancing your asset allocation by moving some of your South African assets into an offshore structure, as I have proposed you should think about doing. Now, let's just quickly look at some of the issues that you should be thinking about or that you should raise with your advisor when you do relook at your estate plan, which I hope you will all do. That's the last time I'll bore you with that. So CGT is one. Of course, in the current scenario, the local assets are either owned by you personally or they're owned by a trust. You will incur CGT if you sell them into a structure. And some of our clients, you'll see the second point, CGT2, some people are liquidating assets presently, okay? Let's just talk about that quickly. Should the fact that you might pay CGT be an absolute no-no in not doing the structure? In my view, not. I think in many cases, if you take the dividends withholding tax saving and the estate duty saving that one can achieve on future profits, the benefit will probably outweigh the fact that you have to pay capital gains tax now. Again, I can't say that it's true in all cases, but certainly in many instances that I've seen, it will be true. This fact is enhanced by the fact that in the COVID pandemic world that we live in, a number of assets have poor values, if I can put it that way. If you track their historic values, they've taken a substantial dive given the economic circumstances, and particularly in the COVID era. That in and of itself is a silver lining because it will help you reduce your CGT bill if you do transfer. If you are liquidating your assets with an eye to moving them offshore, I do think that you should talk to an advisor because there are ways to efficiently liquidate your assets with an eye to moving them offshore. In other words, you can save yourself sometimes CGT if you liquidate assets as part of your estate plan. It's not always true, but it's something to think about. So capital gains tax is something that anyone who is moving assets into an offshore structure needs to take account of. There are ways, in the corporate world, we've been saving capital gains tax for years. It's never an outright saving, but there are ways of optimizing it, and those structures can be used. So my advice on capital gains tax, don't simply sit there and say, I refuse to pay capital gains tax now. You may well benefit by looking into it and seeing what can be achieved, as even if there is a small charge now, the future benefits might outweigh it, okay? The other thing I should mention about the structure, now that we can, hopefully you can see the transitioning slides, is that in this particular slide, Daryl has sold his South African company to the offshore holding company. In future, interestingly, if that offshore holding company sells the South African company, Unless that South African company is a property company, there won't be any CGT. So what I mean by that is that non-residents, which includes the foreign holding company, are not subject to capital gains tax in South Africa. That's just the way the rule works. So although you will pay CGT, in this case, Daryl may have paid some CGT in moving his South African company into the foreign structure, if he ever sells it to a third party in terms of a sort of third party sale, he will no longer be subject to CGT in South Africa because the holding company is not tax resident in South Africa. It is therefore not subject to CGT unless that South African company is what we call a property rich company. That's another factor to consider when you're talking about, well, CGT is an impediment to me moving my assets into a loop structure, because although it is a once-off payment, you won't pay any further CGT in the future. Dividends tax we've discussed. You should be thinking about dividends tax. I'm not saying it's the only factor in choosing a jurisdiction, but it makes sense to choose a jurisdiction with a treaty if you can, so that you're not paying dividends tax on dividends which are externalized if the asset that you move is a company. Estate duty, there's an estate duty benefit as a natural consequence. As I say, if your assets are owned directly from abroad and the profits are going abroad, they no longer need to go via the individual and therefore enrich his estate. So from the estate duty perspective, it's almost a no-brainer given the savings that you'll achieve down the line. Exchange control, ease of administration. What do I mean by that? It is much easier currently, and I'm not saying the rules can't change, for a company, for example, to declare a dividend abroad than for an individual to take money abroad. You will have heard when I spoke about the new rules regarding immigration and the complexity involved in getting tax clearance certificates, etc. None of that currently applies with dividends. So just from an export of cash perspective, it is substantially simpler to move funds within the corporate, from a corporate abroad than via the individual. One of the important factors that you will need to consider is funding required. What do I mean by that? Well, if you've got an asset worth 100 million, do you have to try and raise 100 million offshore to buy the asset locally? And then do you have to try and get that 100 million that you paid offshore again? The answer is you might, but you'll be happy to know that there are structures available where you can do it on what I like to call an unfunded basis. In other words, you can do it without any cash flows arising. And again, you should talk to Daryl and his team or myself if you are interested in exploring those options. As with everything in estate duty planning, you get one benefit and you get one negative. There are some negatives to those, but it is a massive, massive benefit if you don't have to raise huge amounts of cash abroad to fund the acquisition if you do decide to move your estate planning structure offshore. Finally, you'll see that I've referred to trapped funds. Trapped funds is what I alluded to now. If you do a cash transaction, you must be planning to make sure that the funds that come in to buy the local assets into the foreign structure are not trapped in South Africa. So in essence, what you need to do is, and I've said this, you need to take a holistic view of your facts and circumstances. You need to determine whether or not an offshore structure with a loop involved can enhance your current estate plan. I believe in many cases it will. And then these are some of the things that you need to think about in ensuring that when you do that structure, you are covering all of the bases and you don't have any unforeseen and unwanted consequences. I think that is probably a good time for me to pause. I do apologize if any of it got very technical, but I hope that I explained the basics for those who haven't been involved in these types of discussions before. And then we touched on some of the more technical aspects for those who are interested in some of the technical detail. I do see there's lots of Q&A, so I'm going to pause quickly and just allow the anchor team to guide me as to whether or not there are any particular questions they would like me to address.
Thank you, Andrew. So if you don't mind, I've been taking down a lot of those questions while you've been chatting. So I'll send through a couple of those questions. Quite a few of them at the moment, obviously, as you can imagine, the South African trust structure is very popular from an investment point of view. So you've referred to South African holdco and getting assets held in a South African company abroad. But what happens if I have direct investments in my local trust? How do I get those assets into this offshore structure? And further to that, do you think it's plausible that from an exchange control point of view, local trust may be able to invest directly offshore in the future? You're on mute.
Before I get into a flourish. Yeah, those are both excellent questions. Let me deal with the second one first. The second one I don't know. Trusts, for some reason, you've never been able to own offshore assets. So maybe this hate relationship that regulators have with trusts will continue, and they're not going to let South African trusts externalize funds. To me, that will not achieve much, because even with loops, to some extent, you've opened at least one of the floodgates. Okay, so the loop does allow investment back in, but as you can see, it also allows for ownership abroad. So I would say I wouldn't get too hung up on whether or not they allow trusts to invest abroad, because there are strategies that can easily be implemented which will help this trust take its funds and get them abroad if that's what the family want to do. I'm hopeful, though, if we're going to get rid of exchange controls, let's do the whole deal. I'll say one last thing on that. I'm not sure that even if they do let trusts invest abroad, that you would keep your primary estate planning location as South Africa. In other words, even if your trust could invest abroad, I'm not sure that it wouldn't be worthwhile rather moving the assets into a foreign structure than keeping your South African trust as a primary estate planning base. The second question, Daryl, what if my trust owns the assets directly? A lot of the structures do work better where you're moving corporates, okay? And for that reason, many of you will have heard of Section 42. If you haven't heard of Section 42, don't worry about it. But Section 42 is a section in the Income Tax Act that creates a dispensation where effectively taxpayers are moving assets into companies. So to answer your question, it's very, very easy if a trust has assets held in its name directly to corporatize those assets by moving them into a corporate entity using Section 42 of the Income Tax Act. And that will lead to no tax charge at the time that you do that.
That's great. Okay, also a lot of questions being asked here, Andrew. Just to clarify, please. So you're moving assets from South Africa abroad into a structure. Am I moving those assets out of my estate? Yes,
very good question. And one of the really significant impacts can be that, so recently, and it's just coincidence, I've consulted with a number of high net worths who still own substantial assets in their own names, and in particular, the family companies. Because we will move those assets into a foreign estate plan, there are techniques to do it where you will move them out of your estate. And if you think back to the diagram that I showed earlier where I used your name, Daryl owned nothing except he had an interest in the foreign trust, and the assets were wholly owned or substantially owned by the foreign trust. So yes, part of the goal is to move them out of your estate into that foreign structure.
Would you not have created, sorry, just to clarify again, would you not have created a loan into the foreign company which would still form part of your estate, but future growth in those assets wouldn't?
There are several structures available, some of which you do create a loan, but others in which you don't. And the reason that I'm being a little evasive on that, Daryl, is I don't want to get into the detail. They get quite technical, and I suspect we might lose some of the audience. But suffice to say, there are ways you can do it where you don't create a loan asset. And I would suggest, I don't want you to field a million calls, Daryl, but I would suggest that if people do have questions, that they raise it with you guys, and if you guys will see fit to bring me in or whoever to discuss ways of achieving that.
Yeah. Okay, Andrew, you've referred a few times to more tax-favorable jurisdictions from a dividend withholding tax perspective. Can you give us a couple of examples of a few of those jurisdictions? Which are the more popular ones for South African investors in your experience?
Yes. So, as I said, many of the double tax agreements drop the dividend withholding tax to 5%, and that includes Mauritius, and in fact, most of the countries do. Some of the countries that drop it to zero are, for instance, the UK, Netherlands, Sweden, Malta. So there are a couple of jurisdictions that drop it to 0%. And if I can bore you for 1 minute, Daryl, a lot of people say, how is it possible that our treaties allow this? So, you know, if I keep the dividend owned in South Africa, it's 20%, but by moving it abroad, it's 0%. And the answer is that when a lot of these treaties were negotiated, the older of us in the audience will remember there was a thing called the secondary tax on companies. And the secondary tax on companies was, in all respects, a dividend tax, but it was levied on the company rather than the shareholder. So when they negotiated these treaties, they weren't giving anything away by lowering the dividends tax rate as they have done, because the dividend withholding tax clauses in the treaties didn't impact STC. So in other words, it was a bit short-sighted when they did the treaties to say, well, we don't care, our dividends tax is levied on the companies. When we switch to a dividend tax on individuals, this opportunity arises. And the reason that it's never been publicized before is why? We couldn't loop.
Got you. So if you could just rehash, and this is not new, but what are the requirements currently to be deemed a non-South African tax resident?
Great question as well. So one of the tests is what we call an intention test, and it's called ordinarily resident. It's the primary test. And you're ordinarily resident in South Africa if you regard it as your home. Now that sounds a little bit woolly, but you will say, I regard South Africa as my home, then you tax resident, or I don't, I regard somewhere else as your home. And then what the test entails is to check whether or not that's true. And some of the indicators of the place that you regard as your home is, where does your family live? Where's your business? Where's your center of vital interests? Where have you reserved a grave site? Has been something. So there's a lot of sort of quite twee little tests that we apply. But the primary test is an intention test as to where you regard as your home. The second test, okay, which doesn't actually apply to South Africans because most of us are ordinarily resident, is a physical presence test. And that's for somebody who has traditionally not lived in South Africa and then comes to South Africa and lives here for extended periods of time. If they meet certain thresholds, they can become tax resident on that basis. The one thing I just want to caution, everybody says to me, I'm not tax resident, I've been counting my days. It's gobbledygook, okay? It doesn't matter how many days you spend in South Africa. Don't tell me about 183 days. They relate to other tests completely. You can spend 600 days consecutively out of South Africa and still be ordinarily resident in South Africa if you regard it as your home. So ordinarily resident is the one that people misunderstand, and it's a key test.
Right, okay, so I'm in the process now of immigrating, 2021. I'm in process right now. What does that mean for me once I've got the green light? Does that mean that I can take out more than my 1 million rand single discretionary without the need for any tax clearances, any further approvals, or what are the actual implications?
Yeah, so the way I read it, and please bear in mind, as I said to you, it's so new, it came out on Monday. The way I read it is as follows. You will need to immigrate for tax. You can no longer financially immigrate, i.e. immigrate for exchange control, without immigrating for tax. Okay, so you will need to cease to be ordinarily resident, or you will need to be breaking the physical presence test if you were an import, if I can put it that way. Okay, so you need to do your exit tax return, your CGT return, where you, number one, they ask you, did you immigrate during the year of assessment? You're going to say yes, and then there's going to be deemed CGT. You will then have to do a tax clearance certificate, which will be a specific one that will confirm that you have immigrated during that tax year. Okay. You will then go to exchange control. As I say, your allowances are now aligned to residence allowances. So number one, you can take out your R1 million discretionary allowance just with AD approval. Easy. You can take out the 10 million offshore investment allowance. Relatively easy, particularly if you've got your tax clearance certificate. Anything over and above that, currently they say it has to go to SARB. But my sense, given that they are releasing block funds of past immigrants now, if I read the notice correctly, my sense is that as long as you've done your regulatory tests and you can prove anti-money laundering source of funds, full tax compliance, they will let those funds go abroad. And just as an anecdotal piece on that, in recent times, over the last 6 months to 12 months, people have moved some really significant amounts using specific approvals to move funds which go to the SARB. So there is a trend showing that SARB is letting substantial amounts go.
A couple of questions just to everyone in the audience today asking about recordings of this. There will be a recording that is sent out to everyone that was attending today, so you don't need to worry about that if you need to log off earlier than the allotted time. Andrew, let's talk a little bit about retirement funds, living annuities, preservation funds and the like. Any changes there? Am I now able to take out my living annuity in one shot or still restricted?
The restriction on those sorts of products has now been moved to, you have to have been a tax immigrant, i.e. you have to have immigrated for 3 consecutive years before you can move those. So previously, once you did that form I referred to, the MP336, and you ceased to be an exchange control resident, you could access your pension funds and take them abroad. Now, and I'm not a pension fund expert, so if I use the wrong terminology, you'll help me, Daryl, but certainly pension funds, I can say with confidence, you need to now have been tax resident for a uninterrupted period of 3 years before you'll be able to move those funds.
Is there a limitation on the nature or percentage of the South African asset that the offshore structure can hold?
No, there is none. And I sort of alluded to this. For me, this is very significant, and I've spent a good part of this year in discussions with authorized dealers who are really the liaison between us and the Reserve Bank. Legally, the current amendment deletes all prohibitions on loops, okay? So even where people are getting used to what's happened, and it's, for some people it's a slow process, very difficult to accept that loops are gone in their entirety. But there isn't a type of loop that is prohibited anymore. It isn't like you can loop but not in these instances or only up to this percentage. The prohibitions, the sections that prohibit loops are gone. And as a lawyer, I read that, and perhaps I'm biased, but I read that to say any loop is fine. So in my view, there is no limit on assets. You may have heard in the market that you can only do it with pre-existing offshore funds. I strongly believe that is incorrect. You can take funds abroad and fund an acquisition under a loop. The prohibition against loop, the sections that prohibited them are deleted.
Quite a specific question. So if I've moved funds into another SADC country, let's use an example to buy a property, am I still required to repatriate those funds back to South Africa if the property is sold?
So when you say SADC, I'm going to just use a different terminology, if you don't mind, common monetary area.
Yeah.
Okay. Common monetary area is important because that's Lesotho, Swaziland, and Namibia, which are under the exchange control regime, and there you could move funds broadly. SADC does include some countries that are outside of the common monetary area, and there you would need to look at your approval. You would have got an approval, whereas in the common monetary area you wouldn't. One of the interesting things, though, is to have a look now. Those clients that we've got that have moved funds greater than 11 million in a particular year, a lot of them came with conditions, and to your point, investments into SADC may have come with conditions as well. It's now worth revisiting, in my view, whether or not exchange control are still going to apply those conditions. In other words, if I moved 500 million in 2019 and there are a whole lot of conditions imposed, I don't think there's much to lose in going back to my AD and saying, I see there's been some changes. Is it true that these conditions are still apply, or can we get some relaxation? And in all cases, you'll be better off if you can get the conditions removed. I'm not guaranteeing it. I'm just saying it's worth doing.
Yeah. All right. Andrew, I'm going to ask you one more question, an unanswerable question, if you don't mind. And then I'll let you wrap up from our side. Just again, to the audience, we've got a lot of questions coming through, very specific questions around individual situations. So this is an evolving process, and we will endeavor to keep everyone updated as things change. But from an advice point of view, as Andrew is, and certainly I've mentioned a few times, please feel free to contact Anchor, your financial advisor, or Andrew directly for further advice on individual situations. Right, so the unanswerable question, Andrew, is I go through this entire process. I pay a lot of money, or potentially not a lot of money, but I pay money. I leak some tax if I don't use Section 42. I get everything into my offshore structure. I've got my estate planning right, and things change. What do you think the likelihood of some of these relaxations coming into play are changed, at least in the foreseeable future?
It's a great question, and it's one I always get asked. Number one, although many individuals don't do it this way, estate planning is a dynamic process, and it deals with here and now. Every day that you wake up, you must make sure that you've got the best estate plan. And that means the best for the current regulatory regime. You can't plan for future regimes because you don't know what they are. But it is important what I said. To me, the trend is clear. Things are going to get better, not worse. Now, it's not impossible that exchange control, there's a massive policy change within the government, and somebody wakes up and says, we've made a huge mistake. They fire Tito and Mboweni, and they say, we've made a huge mistake by relaxing exchange controls and going back. That's not impossible. It's unlikely, but it's not impossible. Me personally, I'd rather have gone through the door legally while the door was open than be dealing with and have to deal with that scenario than not do it because I'm worried about a future policy change. So that's a policy change to the negative. I think it's unlikely, but I believe you should all be doing your relooking into estate plan now because we know what the rules are now and they're favorable. Let's do it when the rules are favorable. That said, once you are into an offshore estate plan, if you don't have one now, or even if you do have one, it is a much more complex structure and it requires constant updating, which is why many people who have these estate plans deal with people like Daryl because they keep it current, okay? And it is possible that we're going to have to monitor laws. You may have paid more tax than you will in future. I don't know. So maybe there's a future change. It's such a drastic change that, in fact, if we had just waited, we could have done it better. Again, I just come back to the point. Estate planning is a here and now exercise. And we just can't predict what's going to happen. And I think the here and now is favorable. I think people should be moving now in the next few months to make sure that they get their structures up.
Said that was the last question, but there have been quite a few questions around this topic, so I'm going to ask it, and please feel free to say it's not in your area of expertise. Okay. We've talked a lot about the use of offshore structures from an estate planning point of view. Now let's talk a little bit about CITES taxes, Andrew, and assets held directly by South African or foreign investors in jurisdictions like the US and the UK, listed shares. Yeah. Is CITES something we need to be concerned about? Is this a mythical beast that everyone threatens us with but never gets enforced, or is it a real consideration?
Well, let me give you my experience and then you can weigh in as well. I'm sure you guys have seen it. To me, it is a real consideration, okay? And these taxes are very, very complex. We did a South African bought a big farm in the UK. The CITES tax, as you can see, CMS is part of a global network. We've got a massive, massive office in London. We did some really, really sophisticated planning around the CITES tax in the UK. If you get it wrong, okay, the tax in both the UK and America, and I stand to be corrected, I think they're around the 40% mark. So it's an absolutely massive tax. Now, there are structures that can be implemented which can ensure that you're not subject to the CITES tax. Many of them tie in neatly to our estate planning structures, so it's not like they're additional expensive structures. But to me, when I'm investing abroad, and this is the advice I always give people, make sure that you understand the regulatory framework in the jurisdiction that you're investing, and that includes CITES taxes. And if you can't structure around it, if you do your calculations on your returns, and then you factor in that you're going to die one day and you're going to get hit with 40% there, I think it's absolutely terrifying. And I think it's a disincentive to invest in those jurisdictions. If I couldn't manage the CITES taxes, I believe that in many cases, that level of tax will undermine your return. So, but the good news is that you can often manage them. In other words, you can create structures where you don't trigger the CITES tax, but it requires specific advice from offshore advisors. And I stress that. A lot of South African advisors believe they know the rules. They are nuanced. Please take local advice when you are navigating things like the CITES tax.
All right, perfect. Thank you, everyone, again. In addition to the recording, which, as I've mentioned, will be sent out, Anchor, with Andrew's assistance, will be putting together a document highlighting some of the key themes that we've spoken about today. The process is fluid, and we'll keep you up to date as things progress. Appreciate all of your time. Andrew, appreciate your time and insights. Everybody have a fantastic day further.